Disclaimer: this video is for educational and informational purposes only. It is not financial advice. Always do your own research or consult a licensed financial professional before making investment decisions. ETFs. Everyone loves them. They're simple, cheap, diversified, and often presented as one of the safest ways to invest. But here's the truth nobody talks about. Not all ETFs are safe. Some are stable and perfect for long-term investing, and others, they're ticking time bombs disguised as easy investing. Today, we're breaking down the real risks behind ETFs, the ones most new investors never see. Because before you invest in anything, you need to know not just the potential returns, but the potential consequences. Let's start with the biggest myth of all. ETFs are always diversified. No, some ETFs are incredibly diversified, like global market ETFs with thousands of companies. But others are laser-focused on one tiny corner of the market. You might think you're buying something safe because it's called an ETF, but if it only holds 20 companies in one sector, that's not diversification. That's concentration risk. Take a sector ETF like technology. Sounds exciting until tech stocks crash, or energy ETFs. Great when oil prices surge, painful when they drop. When the sector falls, your ETF falls with it. Diversification only works if your ETF actually diversifies across different types of assets. Another thing most people miss: some ETFs are extremely volatile. Just because an ETF groups multiple stocks together doesn't mean it magically lowers risk. If those stocks are all in a high-risk category, like biotech, emerging markets, or small caps, the ETF becomes just as volatile as its underlying assets. Let's take an example. Imagine a biotech ETF. Biotech companies are unpredictable. One breakthrough drug can multiply a stock's price overnight, and one failed FDA approval can crash it. Put 30 of those inside an ETF, and what do you get? An ETF that behaves like a roller coaster. Fun when it's going up, terrifying when it drops. Now let's talk about something even more dangerous: leveraged ETFs. These are the 2x or 3x ETFs you see floating around, the ones that promise double or triple the daily return of an index. Sounds powerful, right? In reality, they're some of the riskiest products in the ETF world. Leverage ETFs reset every single day. That means in volatile markets, they often lose money even if the overall index goes up. Invest in these long-term, and you're basically playing financial roulette. But the risks don't stop there. Another hidden danger is geographic exposure. Many people buy an international ETF thinking they're getting global exposure. But look inside, and sometimes 60 to 70% of the holdings are in one country, like China or India. If that country faces political instability, economic decline, or currency issues, your international diversification can turn into concentrated risk very quickly. And speaking of currencies, here's another risk most investors never think about: currency fluctuations. If you invest in an ETF denominated in a different currency from your own, your returns depend not just on the ETF performance, but also on exchange rates. If the ETF goes up 5%, but the currency drops 5%, you made nothing. Sometimes you even lose money, even when the ETF performs well. Now let's talk about something more subtle: liquidity risk. When you buy or sell an ETF, you want tight spreads, a small difference between the buying and selling price. But some ETFs are thinly traded, meaning there aren't many investors buying and selling them. This creates large spreads, making it more expensive to buy and more expensive to sell. Over time, these hidden costs quietly eat away at your returns. And finally, the last risk, the one most investors only learn about the hard way: tracking error. ETFs are supposed to follow an index. But because of fees, trading costs, and internal decisions, they almost never match it perfectly. Some ETFs underperform their index year after year, even if the official management fee is low. So are ETFs safe? Yes, if you choose the right ones. And no, if you assume all ETFs work the same. The safest ETFs tend to have broad diversification, thousands of companies, not a handful, low volatility, large, stable companies, not speculative ones, high liquidity, lots of daily trading volume, low fees, because fees compound, low tracking error, meaning they follow their index closely. The riskiest ETFs usually include sector ETFs, commodity ETFs, leveraged ETFs, inverse ETFs, thematic ETFs, with tiny portfolios, ETFs dominated by one country, or risky markets. ETFs are tools, and like any tool, they're only safe if you understand how they work. A hammer can build a house or break your finger. ETFs can build wealth or amplify risk. So the real question isn't, are ETFs safe? It's, do you know what's inside the ETF you're buying? If you found this useful, hit like, subscribe to Money Mindset, and turn on notifications. We post new videos daily to help you understand how money really works. And tell us in the comments, what type of ETF do you invest in, broad market or sector ETFs?